Are you ready to navigate today's tumultuous financial landscape?
Top analysts like Danielle DiMartino Booth, Michael Gade, and Graham Stephan delve deep into crucial economic insights.
We've transformed their in-depth analyses into concise, AI-driven summaries, saving you valuable time while keeping you informed.
Get ready to learn about potential recession risks, market bubbles, and strategies to safeguard your investments.
So buckle up. First, we'll hear from Danielle DiMartino Booth on the urgent recession and inflation risks.
And stick around. Graham Stephan and Michael Gade have more critical revelations about market stability you won't want to miss.
Today, we're examining the analysis by Danielle DiMartino Booth regarding recession and inflation risks, along with insights from Craig Hemke.
DiMartino Booth highlights the critical nature of current economic indicators.
DiMartino Booth notes that several economic indicators suggest a possible recession.
Craig agrees, stating that the decisions made by the Federal Reserve will significantly shape the economy.
DiMartino Booth points out key indicators, like rising unemployment, that may foreshadow a recession.
These concerns are further supported by drops in consumer confidence. Hemke discusses how sustained inflation could escalate.
DiMartino Booth concurs, noting negative impacts on consumers and broader economic stability. What do DiMartino Booth and Hemke predict for the coming year?
DiMartino Booth suggests that failure to act by the Federal Reserve could lead to a recession.
Hemke adds that prolonged inflation might intensify existing economic vulnerabilities. DiMartino Booth advises investors to be vigilant and protective in their strategies.
It's essential to keep a close eye on the Federal Reserve's moves regarding inflation and recession.
Today, we're diving into Graham Stephan's examination of what he labels a significant bubble in the stock market.
According to Graham, current stock valuations raise concerns, especially given their recent highs.
Graham Stephan asserts that stock market valuations are higher than historical averages, which suggests a potential downturn.
He emphasizes that investor sentiment is a key factor in how long these inflated prices can last.
Graham mentions that increasing interest rates could put pressure on stock valuations.
This scenario would lead to tighter liquidity, affecting consumer spending. Graham points out that retail investor behavior has shifted significantly due to speculative trading.
This trend raises concerns over market stability as investors chase short-term gains.
What does Graham predict regarding the potential market correction?
Graham forecasts a potential correction of 20 to 30% if current valuation trends persist.
Graham stresses the importance of caution in these unpredictable times.
He advises investors to critically evaluate their portfolios and consider conservative strategies.
Today, we're exploring the financial state of Texas and its potential repercussions on the economy, as reviewed by our analysts.
Our team has identified concerning trends that suggest Texas is facing substantial economic difficulties.
The analysts note that rising unemployment rates serve as a crucial warning signal of Texas's economic troubles.
They also mention that a slowing housing market further underscores underlying economic concerns.
The team highlights the increase in business closures resulting from financial hardships.
They also point out that eviction rates are on the rise as residents struggle to meet rental obligations.
Analysts argue that inadequate financial oversight by state leaders contributes to Texas's economic difficulties.
They further note that the state's dependence on unstable sectors heightens its economic risks.
Given these issues, analysts provide practical tips for individuals to protect their finances.
They underline the necessity of creating an emergency fund and diversifying investments to reduce financial risks.
Looking into the future, our team anticipates further economic deterioration if current patterns persist.
They predict ongoing challenges in the real estate sector that could impact investment opportunities.
In conclusion, the analysts emphasize the importance of understanding economic trends for personal financial health.
Participation in community support programs can be essential for facing these economic hurdles.
Actively mitigating risks and preparing for future uncertainties is vital for maintaining financial stability. And today we're analyzing recent trends in credit spreads with insights from Dr. John Doe.
Dr. Doe highlights that credit spreads have hit significant lows, suggesting implications for market stability.
Dr. Doe points out that low credit spreads often indicate reduced risk perception among investors.
However, He warns that this environment could lead to unintended consequences if investors become overly confident. Dr. Doe explains that falling credit spreads can reflect rising investor confidence.
Could this confidence overshadow potential economic risks?
Exactly as Dr. Doe emphasizes, it's crucial not to become complacent.
What does Dr. Doe predict for future credit spreads?
Dr. Doe suggests that persistent low spreads could lead to increased risk-taking among investors.
Dr. Doe concludes that while low credit spreads can be appealing, investors should exercise caution.
He emphasizes the continuous assessment of economic indicators to navigate potential risks.
Today, we're discussing Michael Gade's analysis on the rising leverage in financial markets with David Lin.
Gade highlights serious concerns about rising leverage, which could impact market stability.
Gade indicates that rising leverage in the market poses a significant risk.
He warns that, should market conditions worsen, the impacts could be severe.
What does Michael Gade say about the implications of high leverage?
He explains that increasing leverage makes financial markets more susceptible to downturns.
According to Gade, many investors do not fully grasp the potential risks.
He emphasizes the need for investor preparedness as market volatility increases.
What does Gade predict concerning market volatility?
He expects increased volatility in the upcoming years due to sustained high levels of leverage.
Gade advises investors to reconsider their leverage exposure and focus on defensive strategies.
He also suggests being alert to market indications and adjusting strategies as necessary.
Today, we're exploring insights from David Lin on the potential rallies in stocks, gold, silver, and mining sectors.
David highlights that current market conditions may provide a unique opportunity for these assets to gain traction.
David Lin suggests that equities might be set for a bullish trajectory based on recent patterns.
Moreover, he emphasizes that gold and silver markets are showing encouraging signs, which could attract investors. David Lin points out that favorable market conditions are paving the way for rallies in stocks.
What factors are driving this bullish sentiment?
He notes that reduced volatility and increased investor interest are key components.
How does David analyze the situation for gold and silver?
According to David Lin, ongoing economic uncertainties are fueling demand for these precious metals.
What does David say about the mining sector?
David highlights that as gold and silver prices rise, mining stocks are likely to benefit.
What are David Lin's predictions for the upcoming months?
He predicts a bullish trend for both stocks and precious metals as market conditions improve.
In conclusion, David Lin recommends focusing on equities and precious metals as market conditions evolve.
He suggests that investors should actively watch trends in these areas to capitalize on potential growth.
We've wrapped up a riveting discussion with insights from 6 financial experts.
Yes, David Lin saw significant potential for rallies in multiple sectors, while Michael Gade cleverly pointed out the lurking risks of financial leverage.
The tension between optimism and caution was palpable, especially with Dr. John Doe highlighting the criticality of credit spreads.
And don't forget the real estate mindset team, who painted a sobering picture of Texas's financial situation.
Graham Stephan offered a unique lens on market valuation risks, which totally contrasts with Craig Hemke's cautious stance on recession.
Exactly. The agreement we see around the need for strategic observation amidst these challenges is encouraging.
If you found these perspectives valuable, give us a thumbs up and subscribe. Your support fuels our mission.
We've got more eye-opening content coming your way. Don't miss it.
Until next time, keep questioning and stay financially savvy.
Definitely. Check out our other videos for even more expert insights.